Welcome to the Deep Dive. Today, we're cutting through the noise around American Integrity Insurance Group, that's AII, after their Q3 2025 earnings call.
Which was, I think is fair to say, a blockbuster call.
Absolutely. And this is such a key company to watch. They operate in that really complex, specialized Florida property and casualty market.
Right. Not an easy place to do business.
Not at all. And, we've gone through the numbers, and the management team is painting this picture of just overwhelming operational success.
The execution looks flawless.
It does. The whole post-IPO strategy seems to be firing on all cylinders. And yet, and this is the interesting part, the market's reaction was, well, weird.
Muted is a good word. Almost negative on the day.
Exactly. So that's our mission today. We want to understand this paradox. How do you get these stellar numbers, this incredible execution, and have investors basically shrug?
Or run for the exits.
Right. So we're going to dissect the performance, look at the strategy, and try to figure out what the market missed or maybe what risks it saw that we didn't.
Okay, let's start with the headline numbers, because they really did just crush expectations. Non-GAAP EPS came in at 71 cents.
71 cents. And the consensus on the street was what, 61 to 63 cents?
Exactly. So right off the bat, you're looking at a 13 to 16% beat. A huge beat.
And the top line, revenue?
Just as good. Total revenue hit $62 million. The street was way down at $55.6 million. So that's an 11% beat on revenue. This wasn't some kind of financial trick. This was just pure, solid growth.
And that growth is coming from just massive scale up. I saw the policies in force number.
Oh, it's incredible. It's a measure of their customer base, and it grew 48.6% year over year.
Wow.
They're now at 406,094 policies. Just a remarkable expansion.
And it's not just growth for growth's sake. The profitability signal is there.
It's the most important signal. That annualized return on equity, the ROE, basically how well they use shareholder money, it shot up to 17%.
Up from, what, about 12% a year ago?
From 11.9%. A huge jump. It shows the quality of the business they're writing.
Okay, so whenever you look at a P&C insurer, there's one number you skip right to. The combined ratio.
The holy grail. It tells you everything about their underwriting health.
It's how much they pay out in claims and expenses for every dollar they collect. And for AII, this number wasn't just good. It was almost revolutionary for a Florida insurer.
It really was. The combined ratio dropped to 78.9%.
78.9. Just let that sink in.
Yeah.
For every dollar they take in, they're only spending about 79 cents on claims and operations.
The rest is underwriting profit. You compare that to 94.3% in Q3 of 2024.
That kind of shift is, well, it's the definition of underwriting discipline.
It is. And that 78.9 breaks down into a loss ratio of 54.1% and an expense ratio of 24.8%. A sub-80 combined ratio, you usually see that in really safe, boring markets.
Yeah, not Florida, which has historically been a graveyard for insurance companies.
Right. This ratio, on its own, suggests they've structurally changed how to be profitable in that niche.
So let's dig into that. Where did the $239 million in gross premiums written actually come from? That's a huge jump, 48.5% year over year.
And this is where management made a really crucial distinction on the call. The main driver wasn't just taking on policies. It was new and renewal policies in the voluntary market.
So business they actively went out and chose to write.
Exactly. New voluntary writings are up 25% year to date. They're selecting their own risk.
Okay, but they did benefit from those Citizens takeouts, right?
They did, yeah. For anyone not familiar, Citizens is Florida's state insurer of last resort. And while those takeouts added volume, management was very clear. They said the voluntary growth is the predictable long-term driver here.
So they're prioritizing risk selection over just grabbing volume.
That's the signal. They're earning their growth, not just inheriting it.
Which is what you want to see. But they're also pulling some serious financial levers, especially on the expense side.
Oh, absolutely. The expense ratio dropping 10 full percentage points to 24.8% is a massive win.
How did they do that?
Two things, really. First, just pure scale. Spreading their fixed cost over a much bigger policy base.
Classic operating leverage.
Right. And second, and this gets a bit more technical, they're getting stronger ceding commissions.
Okay, explain that.
Think of it like a kickback from their reinsurers. Reinsurers are the companies that insure the insurer. Because AII's underwriting is so good now, they can negotiate better deals, and the reinsurers essentially pay them more for sending them good, profitable risk.
So it's like a subsidy that lowers their net expenses?
Exactly. It's a
Okay.
huge benefit of being a disciplined underwriter.
And that IPO they had earlier in the year, that's really paying off in the investment portfolio now.
It really is. They have a pile of cash.
Yeah.
Net investment income surged 83.8% to $6.9 million.
Wow.
And that's almost entirely from having more cash to invest from the IPO proceeds, earning better rates. You add all that up, and the book value per share just balloons. It's up 28.2% since the end of last year.
So the whole machine is working in sync. Underwriting profits, expense leverage, and investment income.
The whole flywheel is spinning.
Okay, let's get to the core of this, the loss ratio itself. Management spent a lot of time on the call explaining how reinsurance can make the quarterly numbers look, well, a little missed.
Right. This is where you have to understand the mechanics. They confirmed that their gross non-catastrophe loss rate, so their claim costs before any reinsurance, is running exactly where they expect it to. About 17 cents out of every premium dollar. That number is stable. And that internal consistency is exactly what you want to see as an investor.
Okay, so if their actual claims cost is a stable 17 cents, why is the overall net loss ratio up at 54.1%? Why the big gap, and why does it bounce around?
That is the magic or the confusion of their quota-share reinsurance.
Right.
Think of it as a partnership. AII hands over a fixed percentage of all its premiums to a reinsurer. In return, that reinsurer takes on the exact same percentage of all claims, big hurricane claims and small everyday claims.
Okay, so they're sharing the risk and the reward.
Precisely.
Yeah.
Now, in a quiet quarter like Q3, with no big hurricanes, the reinsurer isn't paying out a huge catastrophe claim. But AII still has to hand over a slice of that very profitable premium.
Ah, so they're giving away income.
They're giving away premium.
Right.
And since they're still retaining a portion of the normal underlying claims, their net loss ratio can look temporarily higher.
So it's a trade-off. They're buying protection. They're sacrificing a little bit of profit in the good times for massive stability in the bad time.
You've got it. They're swapping volatility for predictability. And that cost shows up in the net loss ratio during a quiet period. You have to look at the gross number, that's 17 cents, to see the real underwriting discipline.
That makes perfect sense. Okay, let's pivot to the future then. These legislative reforms in Florida have opened up a lot of new ground. What's the growth plan?
Management was very aggressive on this. They laid out a three-pronged attack. First, they're re-entering the Tri-County region.
Miami-Dade, Broward, Palm Beach. Historically a very tough market.
Extremely tough. It's only 6.5% of their book now, but it's 26% of the state's households. That is a massive, massive runway for growth.
Okay, what's prong two?
Targeting what they call middle-aged homes, which are mostly HO3 policies. Think of the most common type of homeowners insurance policy.
Right.
This segment is 25% of all homes in Florida, but it's less than 8% of AII's current portfolio. They used to avoid these homes because of litigation risk.
But now, post-reform, they feel they can actually underwrite them and make money.
That's the bet.
Hold on, though. Going into the Tri-County region and targeting older, higher-risk homes,
Right.
that sounds inherently risky, even with the reforms.
It absolutely is.
I mean, isn't that strategy directly challenging the underwriting discipline we were just praising?
You're right to flag that. It's the key question. They frame it as disciplined expansion. They're betting the reforms have fundamentally de-risked these areas enough that they can hit their 17% gross loss target. But if they're wrong,
If they're wrong, that beautiful 78.9% combined ratio could evaporate pretty quickly.
it could. It's the ultimate test of their risk selection process.
And they're not just expanding in Florida, right? They're building a broader business.
Correct. They've launched a new commercial residential product for condos and HOAs, a totally new segment, and they're planning to expand into North Carolina on top of their existing operations in South Carolina and Georgia.
So they're trying to become a true Southeastern specialist.
That seems to be the goal.
Yep.
Leveraging their platform beyond just the Florida core.
Okay, so all of this sounds pretty bullish, but they did present one key trade-off for 2026. Management said they expect the gross loss ratio to rise by about 1 percentage point.
Yes, a really critical point for anyone building a model.
Why would they do that? Why voluntarily take on a higher loss ratio?
It goes right back to that reinsurance discussion. They're so confident in their underwriting now, they plan to gradually reduce their reliance on that quota-share reinsurance.
Ah, so they want to keep more of the profits for themselves.
Exactly. They feel they can retain a larger share of the profitable premium they're writing. When they do that, they keep more of the premium dollars, but they also keep a larger percentage of the inevitable claims.
So the gross loss ratio they keep on their own books has to go up.
It naturally goes up by about that 1%. It's a calculated move to trade some of that stability for higher net income. They're basically saying, we're so good at this now, we don't need to give away as much profit to our reinsurers.
That is a huge vote of confidence from management, but it definitely complicates the models for analysts.
It does. And speaking of confidence, they had to address the elephant in the room, political risk.
Always the biggest question in Florida. Will the reforms stick?
Right. The fear is always that a new administration comes in and undoes all the progress.
So what was their take on that?
They expressed very high confidence. They said the reforms are durable and will not be undone in the near future. They cited strong support from the governor and the Senate.
So they feel they have political insulation for the next few years.
That was the message. They believe that systemic risk is off the table for now.
I have to push back a little on that, though. Florida politics can turn on a dime. The litigation culture there is deep-rooted. Can you really assume the stability will last 5 or 10 years?
And that is the core debate for any long-term investor here. Management is betting on the intent of the current legislature. They believe the consensus is broad enough to hold.
But you're right, 5 years of stability in Florida insurance is a lifetime.
Exactly. And that uncertainty is probably why their valuation will always have a bit of a discount compared to national peers, at least until they prove they can sustain this through a political cycle.
Which brings us right back to the paradox. Amazing execution, a crazy good combined ratio, clear growth, political assurance, and the stock gets hammered. It closed down 6.5% after being down as much as 15%. What broke the story?
It was a classic case of, well, a few things hitting at once. First, the stock had already run up more than 11% just before the call.
So a sell the news event, some of it was priced in.
Some of it was. But the two big catalysts were specific announcements. First, the news of a looming secondary offering of 3 million shares by existing shareholders.
An overhang.
A big supply overhang. The market just sees a flood of shares coming, and that can depress the price no matter how good the company's doing.
And the second thing?
That guidance normalization we just talked about. The expectation that the gross loss ratio would rise by 1%, even though it's for good reason, some algorithms and investors just hear loss ratio going up and sell.
So they focused on the risk of the rising ratio, not the benefit of the higher retained profit.
Exactly. It was a technical and a guidance issue, not an execution issue.
And that theory seems to be backed up by the analyst reaction afterwards, which was pretty glowing.
Overwhelmingly positive. The analyst community looked right past the overhang. We saw multiple price target increases. One analyst took their full year 2025 EPS forecasts from, 407 all the way to 508.
Wow.
The smart money on the street gets it. They see the fundamental transformation is real, even if there's some short-term noise.
All right, let's switch gears. It's time for our final segment where we try to put all this to work. This is our not financial advice segment, where we pitch one wild but plausible, high-conviction trade idea based on what we've just discussed.
Okay, my idea hinges entirely on the belief that 78.9% combined ratio is durable.
You believe it's structural.
I do. So the trade is a high-conviction long-short pair trade. You go long AII, and you short a basket of their Florida-exposed peers whose combined ratios are still stuck in the mid-80s or even higher.
So you're betting that this performance gap isn't just cyclical, that AII isn't just riding a wave. You're betting they built a fundamentally better boat.
Precisely. The 78.9% ratio suggests AII has truly cracked the code for profitable underwriting in Florida under this new regime, while their competitors are still figuring it out.
And the political confidence removes that big systemic risk, at least for a while.
For the next few years, yes.
Yeah.
So this trade argues that their underwriting strength is repeatable and that they deserve a permanent higher valuation multiple. They're not just a Florida turnaround story anymore.
They're becoming a best-in-class, scaled Southeastern specialist.
And that should command a premium over the competition.
A powerful thesis. Okay, let's wrap this deep dive up. Key takeaways. A massive earnings beat driven by incredible expense leverage and smart strategic growth. But this was all masked by near-term stock pressure from that secondary offering and maybe some market caution around the reinsurance guidance.
And the final provocative thought I'll leave you with is this. As management pulls back on reinsurance to keep more profit and at the same time pushes into higher risk areas like the Tri-County, the real test of their underwriting discipline is coming.
Can they maintain that underlying 17% gross loss rate when they're keeping more of the risk on their own books?
That question. How they answer it will define the next few quarters.
That balance between retained risk and higher profit is what separates the great companies from the good ones. Thank you for joining us for this deep dive. We'll catch you next time as we continue to cut through the noise and give you the facts you need.